You ever watch the market, especially those last few trading hours, and wonder what's really making things tick?
Yeah, it often feels like there's more going on beneath the surface than just the big news headlines, doesn't it?
Exactly. Feels like there's more to it. Well, today we're kind of cracking open the books on a couple of those potential under-the-radar influences,
Yeah,
equity options and leveraged ETFs, those LETFs you hear about.
right.
Consider this your fast track to understanding a pretty complex, but I think crucial part of how stock prices actually move day to day.
Absolutely. And you've pointed us to some really excellent research here. There's that paper on liquidity provision to leveraged ETFs and equity option rebalancing flows. Also the one looking into the multi-day return properties of leveraged index ETFs and the analysis in the market impact of leveraged ETFs.
Okay.
So our goal today, our sort of mission, is to really dig into these sources and pull out what you absolutely need to know. We want to understand how the rebalancing activities tied to these options and LETFs can actually sway stock prices, especially, in those final minutes of trading.
And what that means for market jitters, maybe even potential trading angles.
Precisely. We're looking at volatility and potential opportunities, yeah.
Okay, let's unpack this then. Starting with stock options. Those contracts giving you the right, not the obligation, to buy or sell a stock at a set price. Now, to keep that whole options market, running smoothly, you've got these folks called option market makers.
Right, the liquidity providers, always ready to quote a price, buy or sell.
Exactly. But here's where it gets really interesting, I think. To manage their own risk, because they're holding all these options, they do something called delta hedging.
Right. So delta basically tells a market maker how much their options price is likely to change for every dollar the underlying stock moves. It's like their immediate exposure measure.
Okay, their sensitivity.
Yeah, exactly. And to stay delta neutral, which basically means they don't want to be betting on whether the stock itself goes up or down, they have to constantly adjust their own holdings of that underlying stock.
Constantly tweaking things.
Constantly. If the stock price jumps up, their overall delta changes, and they might need to buy more shares to get back to neutral. If it drops, they might need to sell shares.
And that buying or selling pressure,
Yeah.
that can actually move the stock price itself.
It definitely can, yeah. It can give the stock price a little nudge or sometimes even a big shove, depending on the size of the required hedge.
And it's not just about delta, is it? I saw a mention of another Greek letter, gamma.
Ah, yes, gamma.
From what I gathered, a big gamma imbalance is a key thing to watch. It basically means the delta is like super sensitive to even small price changes.
That's a great way to put it. Gamma measures how much the delta itself changes when the stock price moves. So a large absolute gamma, or a big gamma imbalance, as the paper puts it, implies that the delta is very jumpy. Which means when the stock price moves even a little bit, these delta hedgers have to do a lot more buying or selling to get back to that neutral position we talked about.
Gotcha. So high gamma means potentially large hedging trades are needed?
Precisely. A high gamma imbalance signals a significant potential need for rebalancing. And the liquidity provision paper gives us some, pretty eye-opening examples.
Like the Tesla one.
Exactly. Take Tesla. On one particular day they studied, by 3:30 p.m., the stock had absolutely tanked down over 6%.
Wow.
But get this. It had a positive gamma imbalance. Now, this meant that delta hedgers, to get neutral again, needed to buy an amount of Tesla shares equivalent to a massive 102.11% of the average dollar trading volume typically seen in the last half hour.
Wait, over 100% of the usual last 30 minutes volume? Just for hedging?
Just for hedging. And guess what happened? The price actually reversed and rallied into the close during those final 30 minutes.
That's some serious late-day fireworks.
Yeah.
Driven by that hedging pressure. And you mentioned it wasn't just a one-off with Tesla. There was an Amazon example, too.
Exactly right. Back on June 23, 2016, Amazon had a large positive gamma imbalance as well. But in this case, it contributed to a nearly 4% price drop right at the market open.
Ah, so it can affect the open, too, not just the close.
Yes. The required hedging demand meant market makers needed to purchase Amazon shares equal to about 50% of the average dollar volume seen in the last half hour of trading. So it shows these delta hedging flows can hit at different times.
Okay.
And it's worth remembering, as the paper points out, these delta hedgers aren't just the specialist market makers. They also include big broker-dealer firms managing their own books.
Right. It's a broader group doing this hedging. Okay, so that's the option side market makers hedging gamma exposure. Now let's switch gears. Leveraged ETFs, or LETFs, These are designed to give you like double or triple or inverse double or triple the daily return of an index like the S&P 500.
That daily part is absolutely crucial.
Why is that so important?
Because to promise, say, 2x the daily return of the S&P 500, they have to ensure they start each day with the right amount of exposure. If the S&P goes up 1% today, the 2XL ETF aims for a 2% gain.
Okay.
But to be positioned to deliver another 2x performance tomorrow, relative to tomorrow's starting value, it has to adjust its holdings of the S&P 500 stocks or the futures contracts at the end of today. This daily rebalancing is inherent to how they work.
And that rebalancing means buying or selling the underlying stocks.
Exactly. It can lead to significant buying or selling pressure on those constituent stocks. And just like the option hedging, this often happens near the market's closing bell as they target the official closing prices.
I remember the Liquidity Provision paper had a chart, figure 1, I think, showing the potential timing differences. It suggested the LETF rebalancing might peak slightly differently than the option hedging.
Yes. The bottom panel of that figure illustrated that possibility. While both often concentrate activity near the close, the exact timing and intensity might differ, potentially creating some interesting dynamics in those final minutes.
Okay. Now, for years, there's been a lot of talk, maybe even controversy, around LETFs and this idea of long-term value erosion.
Oh, yes, that's a common critique.
The argument usually goes that because of this constant daily rebalancing, you're essentially buying more after the index goes up and selling after it goes down if you're leveraged long, and they're sort of destined to underperform a simple leveraged portfolio you just buy and hold.
Right, what the Multiday return properties paper calls a non-reset portfolio, basically getting the same initial leverage, but without touching it daily.
And that sounds kind of logical on the surface, right? This constant adjusting feels like it would create drag over time compared to holding a static leveraged position. But the research you shared, it actually throws a bit of a wrench in that conventional wisdom, doesn't it?
It really does. The Multiday return properties paper makes a, I think, quite compelling case that for holding periods of around 63 trading days, that's about 3 months or even shorter, LETF's returns over those multiple days often track those non-reset portfolios quite closely.
Really? So the decay isn't automatic?
Not nearly as automatic or severe as sometimes portrayed. The underperformance or decay relative to that non-reset benchmark only really becomes noticeable with higher volatility in the underlying market and, naturally, a higher leverage factor on the ETF itself.
Okay, so the wilder the market swings day to day, and the bigger the multiplier, like 3x versus 2x, the more that daily reset path can potentially diverge from the buy and hold leveraged path over longer stretches. That makes intuitive sense.
It does. But crucially, the paper also takes a pretty direct shot at some influential earlier research, specifically a 2009 paper by Chang and Madhavan regarding this supposedly inevitable long-term value erosion.
What was their critique?
While the authors of Multiday return properties argue that Chang and Madhavan were essentially using the wrong benchmark, the wrong yardstick. They were comparing the LETF's return to something like, say, the S&P 500's total return raised to the power of the leverage factor, like squared for 2x. Instead of comparing it to the return of a portfolio that was actually leveraged to the same degree but wasn't rebalanced daily, that non-reset portfolio, the correct comparison, they argue, is LETF return versus the non-reset portfolio return. And you have to properly account for the financing costs involved in maintaining that leverage position, like interest on borrowing.
Okay. So it's about comparing apples to apples, one leverage strategy versus another comparable leverage strategy, and making sure you factor in the real-world costs, like financing.
Exactly. It's a more rigorous comparison.
And when you do make that correct comparison, what do they actually find about expected returns?
They found that theoretically the expected return of an LETF is actually pretty much the same as, or potentially even slightly higher than, its corresponding non-reset portfolio.
Wow. So the volatility drag argument doesn't hold up under that framework.
Not in the way the earlier study suggested. Volatility introduces path dependency, sure, but it doesn't automatically lead to long-term underperformance relative to the correct benchmark when financing costs are considered.
That's a pretty significant correction to what I think a lot of people, myself included perhaps, might have believed. The paper also introduces this concept of variance reduction. What's that measuring?
Variance reduction is basically their metric for how closely an LETF tracks the return of its theoretical non-reset portfolio counterpart. Think of it as a measure of tracking reliability for the leveraged exposure over multiple days.
Okay.
A high variance reduction, say closer to 100%, means the LETF is doing a very good job. The returns of the LETF and the non-reset portfolio aren't likely to diverge too much over the holding period. It indicates reliable hedging or reliable delivery of the intended leveraged exposure.
So even with the daily rebalancing causing tiny day-to-day differences, a high variance reduction suggests it's still a pretty accurate tool for getting that specific leveraged exposure over, say, a few weeks or months.
That's the idea, yes.
But what if the variance reduction is lower? Does that automatically mean the LETF is a bad bet or performs poorly?
Not necessarily, and this is another interesting point they make. The paper highlights that even when variance reduction is lower, meaning there's more deviation between the LETF and the non-reset portfolio, those deviations tend to be positively skewed.
Positively skewed.
Meaning the LETF is actually more likely to outperform the non-reset portfolio than underperform it when deviations occur. So the times it doesn't track perfectly, it's statistically more likely to give you a pleasant surprise than an unpleasant one.
Interesting. So you might not hit the exact target perfectly every time, especially in wild markets. But when you miss, it's slightly more likely to be on the upside relative to that non-reset benchmark.
That's what their analysis suggests, yes.
The paper also touches on how extreme market swings can affect this variance reduction metric. They mention the Asian financial crisis.
They did. In really turbulent times, like the Asian financial crisis impact on the MSCI EAFE index back then, volatility was extremely high. In those conditions, variance reduction can indeed drop, especially if you're holding the LETF for longer periods, like a year, or if it has very high leverage.
But how common is that level of volatility?
Well, the authors point out that this level of sustained extreme volatility hasn't really been the norm in major developed markets over the past couple of decades. So for the most part, especially for shorter holding periods, LETFs tend to track their non-reset benchmarks quite well. The main exceptions are those rare periods of intense market chaos, and if you're holding them for a very long time, like a full trading year, around 252 days.
Got it. And just quickly, they also mentioned autocorrelation in index returns. Does that play a big role?
It seems to be a secondary factor. Autocorrelation, the tendency for returns to be followed by similar positive autocorrelation or opposite negative autocorrelation returns, can theoretically influence LETF returns due to the path dependency. However, the paper suggests its quantitative impact isn't as clear-cut or consistently significant as the impact of volatility itself. It's still a bit debated.
Okay, understood. So bringing it back together, we've got these two distinct things potentially driving trading volume late in the day, option delta hedging and LETF rebalancing. What does the combined effect look like? How big of a deal is it?
The Liquidity Provision paper actually tries to quantify this combined pressure. They looked at a sample of stocks and found that for an average of 69 stocks in their sample, the estimated combined rebalancing activity from both sources could exceed 10% of the average dollar volume traded in the last half hour of the day.
10% of AVEND, as they call it.
Right, ADVEND. And for a smaller group, about 12 stocks, it could even go over 25% of ADVEND.
Wow. What were the average amounts for those groups?
For the stocks crossing the 10% threshold, the average combined rebalancing was about 21.23% of ADVEN. For those crossing 25%, the average was a whopping 49.00% of ADVEN.
Almost half of the typical end-of-day trading volume for some stocks.
Well, that's a huge potential for price jolts right at the close, isn't it?
Yeah.
It certainly highlights the potential significance of these flows. But the paper also breaks down which of these two sources, options hedging or LETF rebalancing, is the bigger driver of that volume.
And which one is it?
They found that the lion's share, the vast majority of this combined rebalancing pressure, actually comes from the option market makers adjusting their hedges. That's what they label EHP for gamma hedging pressure.
Okay, EHP.
For those stocks where the total rebalancing exceeded 10% or 25% of ADVEND, somewhere between 72% and 81% of that estimated flow came from the options side, from EHP.
So while LETFs definitely contribute to that end-of-day flurry, it looks like the options market hedging might be the bigger beast when it comes to these specific rebalancing-related trades.
Based on their methodology and findings, yes, that seems to be the case. The option hedging flow appears dominant in scale for these high-impact stocks.
Now, actually tracking and measuring these rebalancing flows in real time, that must be a real headache, right? It can't be easy.
Oh, it's incredibly difficult. The Liquidity Provision paper points out several reasons. First, the options market itself is quite fragmented across different exchanges, and the data reporting isn't always uniform or perfectly transparent about who's doing what.
All right.
Second, those delta hedgers, especially the broker dealers, have some discretion. They don't have to execute their entire hedge precisely at 3:59 p.m. They might smooth it out or use algorithms that trade over a slightly longer period.
Have some wiggle room.
Exactly. And finally, getting a clear, real-time view into the actual inventory positions of all these market makers and dealers is, well, generally not possible for the public. It's largely opaque.
That makes total sense. It's not like there's a public dashboard flashing rebalancing trades happening now.
Yeah.
But even with these challenges, did the researchers explore if this information, maybe the estimated AHP or the LETF pressure, could potentially be used in trading strategies?
They did look into that. They tested whether using the estimated gamma imbalance, 8HP, and the predicted rebalancing pressure from LETFs, which they called LADF, could serve as useful timing signals for short-term trades.
But what do they find? Any edge there?
Interestingly, they found that a strategy based on the gamma imbalance going long stocks with high positive AHP and shorting those with high negative AHP showed some potential for generating positive risk-adjusted returns, even after accounting for estimated transaction costs.
Okay, so the options gamma signals seem to have some predictive power. What about the LETF signal, the LATF?
That one didn't fare so well in their tests. A similar strategy based purely on the expected LETF rebalancing pressure, LATF, did not appear profitable after accounting for those same transaction costs.
So that suggests perhaps that the information embedded in that gamma imbalance figure might be a more potent or maybe more timely indicator for short-term price movements compared to trying to predict the exact impact of LETF flows.
That's one interpretation, yes. It could be that the market is more efficient at anticipating or absorbing the more systematic LETF flows, or perhaps the AHP captures a broader range of hedging pressures more effectively.
Okay. Now, shifting focus slightly, there's been this long-standing concern, almost a fear sometimes, that LETFs themselves, because of their concentrated end-of-day trading, might actually exacerbate market volatility, making those last-minute swings even bigger.
Right, the destabilization argument.
But what does the market impact paper have to say about that particular concern?
That paper, I'd say, offers a more nuanced and, frankly, calming perspective. While some earlier studies, maybe using simpler models, hinted at a potentially significant impact of LETF rebalancing on late-day returns and volatility, more recent analysis, especially the kind that accounts for the actual money flowing into and out of these ETFs daily, suggests that the true impact is likely quite small. Economically insignificant, really, relative to the market's overall average volatility and price movements.
Capital flows. Okay, that seems like a really crucial piece of the puzzle that maybe earlier studies missed. How do those flows affect the needed rebalancing?
Massively. The market impact paper highlights a key pattern. Leveraged ETFs, the long ones, tend to see more money flowing in when the underlying market has gone down that day and more money flowing out when the market has gone up.
So investors are kind of buying the dip and selling the rip within the LETF itself.
In aggregate, yes, that seems to be the tendency. And inverse ETFs, the ones that bet against the market, see the opposite pattern: inflows after market gains, outflows after market drops.
And how does that reduce the rebalancing need?
Well, think about it. If a 2x long LETF needs to buy more stock at the end of a positive day to maintain leverage, but investors are simultaneously pulling money out, those outflows naturally offset some of the buying the fund manager needs to do. Conversely, if the market drops and the fund theoretically needs to sell stock but new money is flowing in, that inflow helps absorb the shares the fund needs to shed, reducing the actual selling pressure on the open market.
So these investor flows act as a kind of automatic dampener or stabilizer, often reducing the amount of trading the LETFs actually need to execute right at the close.
Exactly. And the key takeaway is that if you ignore these capital flows, as some earlier analyses might have implicitly done, you're probably going to significantly overestimate the market impact of the LETF rebalancing itself.
That makes a lot of sense. Okay, so the net effect might be much smaller than the gross theoretical rebalance. What about front running? If these flows were predictable and impactful, wouldn't traders try to jump ahead of them?
You'd certainly expect so. But the market impact paper points out that there isn't really strong, consistent evidence of profitable front-running strategies based on anticipating these LETF rebalancing trades. Meaning, if the price impact was truly significant, predictable, and easy to exploit, you'd see sophisticated traders consistently making money by buying just before the LETFs buy, or selling just before they sell. The apparent lack of such easy profits suggests that any price impact that does occur is likely small, temporary, and probably just fair compensation for the market makers and liquidity providers who facilitate those large end-of-day trades.
Like a small fee for providing immediacy right at the close.
Kind of, yeah, a liquidity premium.
And the market environment itself has changed too, right? You hear a lot about how much more trading happens right at the closing auction these days due to index funds and other passive strategies.
Absolutely. That's another critical point raised in the market impact paper. There's been a significant increase in overall market liquidity right at the closing bell in recent years, largely driven by the growth of index investing and the general rise of ETFs needing to trade at the official close.
So more buyers and sellers are naturally present at that specific time.
Exactly. And because LETFs aim to do their rebalancing as close to that official closing price as possible, this much deeper pool of liquidity at the close can help absorb their trades much more easily without causing significant price dislocations.
Okay, so the market structure has adapted, in a way.
It seems so. Plus, they note the sheer growth in the total assets under management AUM of LETFs since they first launched. If they were truly destabilizing, you might have expected to see major market disruptions attributed to them by now, but that hasn't really materialized. This suggests their impact on overall market quality is probably quite limited.
And one final point on the impact: does it stick around? If there is a small price nudge from LETF rebalancing, what happens next?
Good question. The evidence suggests that any small price impact specifically attributable to LETF rebalancing tends to reverse itself pretty quickly, often overnight. So it doesn't seem to cause lasting distortions in prices.
Okay, so let's try and wrap this up. It sounds like while both option hedging, that LETF rebalancing, LETF definitely contribute to trading activity, especially near the close.
Yes, they certainly generate volume.
The initial fears about LETFs, in particular, really shaking up the market or causing massive volatility might have been, well, perhaps a bit overblown.
That seems to be the conclusion from the more recent comprehensive research, particularly when you factor in those offsetting capital flows and the increased liquidity at the market close.
Option delta hedging seems to be potentially the more dominant force when it comes to the sheer size of end-of-day rebalancing flows and maybe those sharp short-term price wiggles we sometimes see.
Based on the evidence presented in the Liquidity Provision paper, yes, the AHP seems quantitatively larger for the most impacted stocks.
And while LETFs do contribute, their net effect on late-day returns and overall market volatility appears to be economically pretty small for the most part.
Correct. Statistically noticeable, perhaps, but economically minor relative to average market moves.
And that whole narrative about LETFs being destined to lose value over the long run due to volatility decay, that seems much more nuanced now. It really depends on using the right benchmark, comparing to a non-reset portfolio, accounting for financing costs.
Exactly. The inevitable decay argument based on the initial theoretical work seems flawed. For shorter horizons, maybe up to a few months, they generally track their benchmarks reasonably well. High volatility is the main factor causing deviations, especially over longer periods.
Okay, so for everyone listening, the big picture seems to be, yes, there are these potentially significant rebalancing trades happening, driven by both options hedging and LETF mechanics, particularly in those final moments of the trading day.
Definitely happening.
And while these flows are statistically associated with late-day price movements, the actual economic impact of the LETF component seems less dramatic than once thought. And the long-term decay story for LETFs isn't the simple, guaranteed loss it was sometimes made out to be.
That sums it up well. And of course, it's a market that's constantly evolving.
This has been a really insightful dive into some pretty complex market plumbing. Definitely gives you a lot more to think about next time you see those wild end-of-day price swings.
Hopefully, yeah.
And on that note, maybe a final thought for our listeners to ponder. Given this complex interplay we've discussed, and knowing how trading technology and algorithms are always getting more sophisticated, how might the increasing use of AI and advanced algos further influence the impact of these rebalancing flows in the future? Will they dampen it further, or find new ways to exploit it?
Ooh, that's a fascinating question. How do these systematic flows interact with increasingly intelligent, adaptive algorithms? That definitely opens up a whole new area for thinking about future market dynamics.